Greetings. I'm John Butler, Investment Director at Southbank Investment Research. Today, I'm joined by my friend, Brent Johnson of Santiago Capital. Brent's a wealth manager based in the United States, or Puerto Rico to be more specific, and he's also been a friend of mine for some number of years now. In the aftermath of the global financial crisis of 2008, both Brent and I started to fundamentally question the way the economic, financial, and monetary system worked. And we started to develop our own thinking, our own business models, and indeed began to write and present on what we felt were some possible answers to the fundamental questions that we both asked in the aftermath of that crisis. To Brent's credit, he's the one who reached out to me, and we had a very engaging discussion for quite a few years running as we sort of pieced together what we thought the potential long-term consequences of the global financial crisis would be. During that time, Brent originated a theory to try and explain something that caused a lot of misunderstanding and disagreement in the financial community, especially the alternative financial community. And that was why the dollar could be persistently strong even in situations where it seemed like the U.S. economy might be underperforming, where U.S. interest rates were lower than other economies around the world. Brent did a lot of work on this and came up with he called the dollar milkshake theory, which became something of a viral phenomenon for those who follow FinTwit, that is the financial commentary that runs on Twitter. And so with that introduction, hopefully comprehensive enough, but Brent, feel free to add whatever you'd like to add. I'll hand over to you to speak to our viewers about what exactly you mean by the dollar milkshake theory.
Sure. Well, thanks for inviting me on here. It's great to talk to you. One thing I want to say before we get started too far is that the part of the reason I reached out to you was that you had written a book called The Golden Revolution, and I had read it. And I believe that you were actually speaking in San Francisco, and I couldn't make it, but then I happened to be going through London, and we were able to meet together. And the nice thing about speaking to you about gold was that up until that point, most of the people that were involved in gold had come from the gold world. And they were very kind of, I don't know, say indoctrinated. Maybe that's not the right word, but they were very focused on that industry. I was having a lot of trouble finding people in my side of the industry, which is the traditional Wall Street industry, that even wanted to discuss the topic. And the great thing about you was that you had come from traditional Wall Street, City of London, finance, however you want to describe that, but had found your way to gold. And that's kind of what I did too. So we were kind of kindred spirits in the fact that we could, for lack of a better way of saying it, hold our own in a traditional Wall Street boardroom, but also attend a gold conference and speak to all the people there. And so I think that's a good setup for this conversation, because a lot of what we talk about, a lot of times in alternative investments, an alternative way things could be done, it's very theoretical. As a money manager, I have to deal with also the practical and what's actually going on today as opposed to what could be in the future. And I think that's kind of what set up this topic. And so I'm really
fantastic. I mean, and thanks for that elaboration. I do recall, in fact, some of our first discussions. And of course, it did begin with gold specifically, but then it kind of radiated out from there. So please, if you could then, elaborate on this idea of the milkshake theory for our viewers.
Sure. Well, so the milkshake theory for me, it's not something I just woke up one day and said, hey, I'm going to make up this theme and I'm going to pitch it out there. That's, it really kind of developed over a number of years, and it kind of caught a life of its own, partly because it kind of flew in the face of conventional wisdom. But essentially what it was, as it just hinted at a few minutes ago, post-global financial crisis, I was a big believer in gold. And for the record, I am still a very big believer in gold. I think it should be the bedrock of probably everybody's portfolio. Everybody should own it in some form or another. But one of the mainstays of investing in gold, or one of the main reasons people often find the gold world, is the fear that the dollar is going to lose value, or the local currency is going to lose value. And I felt that was probably going to be the case as well, based on the monetary policies of the United States. But then from call it 2012 to 2017 or 18, it just didn't. And not only did it not fall, it rose. Now, we need to be a little bit clarifying here. It rose versus its peer currencies. It perhaps lost purchasing power of what you could buy at the grocery store or in your gas tank or a car or a house. But versus all the other currencies in the world, it did very, very well. And that was very much a conundrum for me. And I couldn't really understand it. And at one point, I just had to kind of go back and start all over. And I realized, in doing this, I had done very good work, or at least in my opinion, had done very good work analyzing the U.S. economy and the U.S. fiscal situation. The problem was that I didn't analyze the fiscal situation in England or Europe or Japan or China or Australia, et cetera, et cetera, et cetera. And when I started doing that, I started realizing, holy cow, these countries have a lot of problems of their own, right? And when you understand that currencies trade relative to each other and not relative to something other than potentially gold or some hard asset, then you can start to figure out that, well, due to a number of factors based on just the design of the system and the fact that the United States is a global economic and military power, it has a number of advantages that many other countries just don't have. Now, whether they should or should not, that's a whole other question. The fact is that they do. And that helped me understand why I thought that the dollar would rise versus foreign currencies. And I think you and I probably agree that there's too much debt in the world, and that will eventually have consequences. And my belief is when we get into that crisis as a result of all the debt, the dollar will rise versus foreign currencies. And when that happens, bad things tend to happen in the world. And so I felt like what would happen is there would be a flight to safety, or at least perceived safety. Perhaps not real safety, but perceived safety to the dollar. And then that was the analogy of drinking up the milkshake. And the reason I used that analogy was because typically the response to a crisis all over the world, not just the United States, is to print more money, inject liquidity, bail out the banks, et cetera. Typically, monetary authorities and governments will flood a market with liquidity to kind of counteract the negative effects of a crisis. And I thought that the liquidity that gets injected would get sucked up by the U.S. dollar and the U.S. markets. And that would be the way that you could get a potentially rising price of gold, a rising price of dollar, and potentially even rising price of U.S. assets versus the rest of the world. So that's a fairly quick summary of the milkshake theory. I hope it makes sense, and I hope I set it up.
It makes sense to me, and in fact, I've written quite a lot about, I don't call it the milkshake theory. You might call my variation of this the reflex theory. That is, there are so many investors, extremely large institutions in some cases, as well as other types of largely institutional investors who have various requirements they simply must follow. And they also have certain types of credit lines and leverage lines with the banks that give them their marginal liquidity for taking marginal risk in the system. And the fact is, if liquidity begins to dry up, and the dollar being the base currency for the global system, basically, de facto, ultimately that's going to be a dollar-related phenomenon, then there's a lot of things that almost have to happen without perception and without discretion. That is, they are reflex responses embedded in the system that can cause a flight into dollars and take what would have been a linear development and turn it into a non-linear one. And the dollar squeezes higher as a result of that without anyone taking a view per se and actively allocating risk in that way versus another way. So that's kind of the angle that I approach it from. But I think there's a lot of overlap there. And again, you might say...
No, I agree. I think that's a great way of saying it. And I think perhaps you... And not to jump on top here, but you make a good point, and I think this is important, especially for individuals to understand. Individuals may take a look at the situation and just say, you know what, I'm not doing anything. I'm stepping back. I'm sitting in cash. This is not a game I want to play. Totally legitimate response and action to be taken. But to your point, very large institutions are not allowed to do that. To your point, they must do certain things, whether they want to or not. And so and this is why I have, as part of, speaking about this, I've said, there's a difference between what I might want to happen and what's actually going to happen. And you need to kind of, when you're allocating capital, you need to understand the things that will happen regardless of whether you...
Absolutely. And I think that you're very good at articulating the difference between the two, because some people, when it gets to these topics, they do get almost borderline religious. I've even received a little bit of that criticism at times. And so I too need to carefully qualify what I'm saying and what sort of time horizon I'm speaking about and what sort of set of conditions I'm speaking about in enough detail so people understand what it is I'm getting at. Because unlike you, I need to be able to trade and survive my way through what is not a straight line from here to there. That's not the way the world works. And so I absolutely get it. And I'm sure that everyone viewing this will also have some appreciation for that, because our client base tends to be overwhelmingly investors who apply a certain degree of individual discretion at varying levels of frequency in trying to grow their portfolios as best they possibly can. And that kind of brings me across the pond a bit. I know that you're obviously naturally big picture dollar, gold, U.S. based, but you've also mentioned global developments and how there's two sides to every exchange rate. And of course, one of those exchange rates is sterling. Is there anything relevant or in relative terms differentiating? Is there anything that you can draw out of your milkshake framework that has any practical relevance for what sterling might do?
Yeah, well, and again, we need to clarify timeframes, right? I certainly am not going to sit here and say that tomorrow this is going to happen with the sterling. I will say it's kind of at its highest level of the year right now versus the dollar. I'm not, and I really focus on dollar crosses, so I'm not sure where it is relative to the yen or the euro, but versus the dollar, it's at its high of the year. And I am of the belief that the first half of the year was pretty calm in global markets. I would be surprised if the second half of the year was as calm as the first half of the year. Now, we had a little bit of a hiccup in March with the banks. I would expect that probably to kind of resurface. I would also say while those troubles with the U.S. banks showed up, they haven't really showed up in mass in Europe yet. But the same reasons that led to the banking crisis in the United States played out in Europe as well, because while in the U.S. banks bought very low yielding treasuries, the European banks bought negative yielding treasuries. So the idea that it can happen here, but it can't happen there, I think you should re-examine that if that's your belief. And so I would think that anybody who is looking to sit in cash or short-term instruments and was either in Europe where the euro's near its high of the year and the pound where it's at its high of the year may want to consider leaving their cash in the dollar for the next 6 months. Now, I know that kind of sounds like I'm speaking my book a little bit, but my book is the way it is because of my beliefs. And if we do have higher volatility in the second half of the year than the first half of the year, for the points I pointed out and the reflexive points that you've pointed out, I think would lead to dollar strength. I think that the whole world has a number of challenges. I think the UK has a number of them as well. And I think they're really caught in a really tough spot between fighting inflation and supporting the markets. A year ago, not even a year ago, 9 months ago, the Bank of England had to step in and get heavily involved in the gilt market, right? And this is the problem: is the things that you do to save the bond market are typically opposite of the things you do to save the currency. It's been my experience that countries ultimately choose to sacrifice the currency as opposed to sacrificing the bond market. And so when I consider those things and I look at the pound and the British market right now, considering the pound is at its highest point since that crisis last fall, to me, I maybe a time to take some exposure off the table.
Well,
here.
That's certainly something worth considering. And I mean, as you know, I've been banging the stagflation drum for quite a while. That is, that central banks were going to end up boxed into a corner where they've just got this increasingly impossible trade-off between unacceptably high inflation and unacceptably poor economic growth. But as you say, when push comes to shove, there's overwhelming historical evidence that central banks tend to choose currency devaluation over potential bankruptcy, bank failures, and financial crises, which is the other side of that trade-off. Also, you could argue that that's not just history. There's some you can actually argue the theory of it itself. That is, bankruptcy tends to be a long, drawn-out, high-friction process which just devastates economies, whereas you could argue a currency devaluation does not gum up the system because it doesn't become a legal, protracted issue that has to go before the courts for everyone to claim who owes what to whom over a multi-month or multi-year period of time. So, I mean, that's...
You're right. It's done, right? You wake up the next day and the devaluation is done.
So I think there's a theory that helps to explain the history there. But as you say, I mean, the UK has these challenges, the Euro area has these challenges, and I've also done some work in the bank accounting area. And one thing that's clear, especially in the Euro area, is that the way banks account for their running P&L, mark-to-market, non-performing loans, all these bread and butter aspects of a bank balance sheet, it's considerably more opaque on this side of the pond than over in North America. And that may be one reason why U.S. banks are quicker to fail under sharply rising interest rates than is the case over here. Now, that's speculation on my part, but there is some evidence to that effect in the way bank accounting practices take place. So that's one thing to consider there too. Finally, I would just want to move from talking about currencies to trying to give our viewers some sense of what the implications of these developments, and as you say, the disruptions that might be on the way during the second half of the year, what might that mean for stock markets? You've mentioned bonds a little bit. That is, they're going to protect. No, central banks are going to protect their bond markets and try to prevent defaults on any major scale. But what might that mean for stock markets here in the UK or elsewhere?
Yeah, well, in sticking with my overall thesis, I always have kind of a short-term view and a longer-term view, medium-term view and a long-term view. And so this is where I'll say that the thing that I did not say at the beginning of this program with regards to the milkshake theory that I try to say in every interview is, though, even though I think it could be in the short to medium term positive for the United States, in the long term, it does not end well. It doesn't end well for anybody, and that includes the United States. It does not end well for the United States. Now, I think that equity markets have gotten too far ahead of themselves in the short term. And when I say equity markets, I mean specifically in the United States, but I also mean in Europe and the UK and other places. I think that in the short to medium term, and when I say short to medium term, the next few weeks, the next few months, I expect there to be a correction. Now, I don't want to come across as a permabull because I'm actually not, at least as it relates to U.S. equities. Again, I think we kind of need a short-term reset because things have gotten ahead of themselves. But when we get that pullback, I think it's possible, and I will have to reevaluate at the time, that if a crisis develops and capital starts to leave other jurisdictions, whether it's Europe, whether it's Asia, South America, I think as it flows into the dollar, I doubt if it just stays in cash. And I think it has the potential to flow into U.S. equities, especially if sovereign bonds, again, whether that includes U.S. Treasuries, whether it includes UK gilts, whether it includes sovereign bonds across Europe or Asia, as those start to get rejected for counterparty concerns or whatever reasons, I think that capital has the potential to flow into large U.S. blue chip equities. Again, not because it should, but for the reflexivity reasons which you have mentioned prior. So I'm more bearish outside the United States than I am inside the United States. But I think in the short term, sometime in the next, call it 2 to 3 months, this is called Q3, I think it's very likely that the effects of all the rate hikes that have happened over the last 15 months start to show up in the economy. And I don't think that we will still be at these levels 3 months from now as we are today. Now, I always preface this as well, is this is not me telling everybody to go out and sell everything they own. I'm just saying this is the time to be
right. Well, I would certainly agree with that. And indeed, I've written several articles to that effect recently. One thing that I do point out, however, you say that the U.S. has certain advantages vis-a-vis other stock markets globally in this scenario that you see potentially unfolding. Oddly enough, though, the UK is a smaller market for sure, but the composition of UK large caps is actually a more defensive allocation sector by sector than what you find in the United States. That is, if you take a look at the Dow and if you take a look at the S&P, discretionary sectors and tech really have a dominant impact on valuations in a way they don't in the UK. And it's my concern, and I'm curious what you think about this, that those industries that depend disproportionately on intangible long-term asset valuation assumptions are more vulnerable to a general pullback than mature, cash-generative, more traditional, low margin perhaps, and not sexy or trendy, but dependable businesses paying stable dividends. Those are relative safe havens, and they dominate the FTSE. Don't get me wrong. I mean, there's risky stuff over here too.
Yeah, no. This is a. I think we're thinking along the same lines. My reason for focusing on the U.S. is not the total exclusion of the rest of the world, but we just have a number of large blue chip companies that are defensive nature that pay a dividend. If you can find those same companies on the FTSE that perhaps don't have the exposure to the high-flying tech stocks that we do here, and you live in England and you're getting paid in pounds and you spend in pounds, having a nice source of pound dividends is a great asset.
One that tends
right?
to
your point,
with if not outperform inflation, something you can't say. Can't say a lot of other assets.
That's and so you could have, as it is, if gilt markets come under pressure again, right, and yields rise and bond prices fall, those well-paying high cap or large cap British paying companies that are paying a nice dividend could be a source of receipt of the funds coming out of the gilt market. And it for people who have exposure to equities, really in any part of the world. Again, I favor the U.S., but no matter where you're having exposure, I think in the years ahead, you are going to be better off in the large cap blue chip paying stocks than you are in the small cap high flying stocks. Now, I actually believe that I think we need this pullback, especially in technology, U.S. technology. But after that pullback, it would not surprise me if these the tech performance this year is really driven by half a dozen to 10 stocks, right? Very, 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 very concentrated. I think after those pull back, I think you might, if you're looking for some growth, it might not be a bad idea for a small percent of your portfolio to go into those positions. Because I do think if there is going to be any growth in the world, that is probably where it's going to come. So if you're looking for some kind of a equity kicker on top of your high dividend paying stocks with a small percent of your portfolio, you may want to consider those, but I would not buy them.
I think that's probably very practical and sensible advice. And I do, whenever I get defensive, because I have something of a reputation as being a bit of a perma-bear, as you know, but I'm not a perma-bear.
I do too.
A perma-bear in valuation terms, because if inflation remains elevated, price earnings ratios can compress without the stock market ever correcting at all. So I approach it more from a valuation perspective. Yeah. But yes, as you say, there might be some near-term danger we have to be aware of. But as you say, there's always some part of the economy where you've got new technology, you've got some ingenuity, you have some very hardworking people who have rolled up their sleeves and done their homework and are building the better mousetrap. And you should always be on the lookout for that, for sure. And indeed, some of my colleagues do precisely that. And it's actually quite refreshing to speak to them when I start getting a bit too defensive, because it's important to throw a little bit of optimism in there. Well, Well, great. I mean, this has been a good chit chat with some good practical, actionable advice. Is there anything else before we close that you'd like to add, or perhaps also let our viewers know where they might be able to follow you, your work, and hear some more thoughts?
Sure. So I'm pretty active on Twitter, as you know. Santiago AU Fund is my handle. If you look up Santiago Capital and look for a white seashell, that's the logo. A friend of mine and I, we record a weekly show. It's called Milkshakes, Markets, and Madness, where we just it's just a lighthearted, 20 or 30 minute recap of the week. That can be found. You can find more information there for milkshakespod.com. And then I do a number of these. I appreciate you coming on and having me here to talk with you. It's been fun. I always enjoy these things. The one piece of information that I try to always impart as well, without sounding too preachy, I don't like to get on my soapbox, but one of the phenomenons I've witnessed over the last 10 years, much to my chagrin and astonishment, is the level of certainty that people have when they tell me what they think is going to happen. I've been doing this for close to 25 years. I think you probably have as well. To me, it's the most uncertain time ever. I don't know what's going to happen. So when I talk to other people who are certain that they know what's going to happen, I'm always a little surprised. And I think this is a very uncertain time. I think it's great to have conviction, but I think it's also great to have flexibility. So try to keep an open mind, regardless of how crazy the idea sounds, because it might happen. So I would just kind of leave it at that. I think that's kind of general advice, but hopefully it's something.
Well, it's very sound advice if you ask me. So thanks for throwing that in there.
Yeah,
thanks
great.
for joining
well,
us,
again, I
man.
appreciate you.
Terrific. My pleasure. I'm sure our viewers appreciate this. Yeah, maybe we'll do this again sometime. But good luck. Good luck trading. Good luck investigating, and good luck with all that uncertainty out there. And I look forward to seeing you again soon. Once again, I was John Butler chatting with Brent Johnson of Santiago Capital. Thanks for watching.